Hi, everyone. We've got another Fed meeting done. We just got through the July Fed meeting. What do we make of it? What do we make of the moves or lack thereof in rates? So first of all, the basic takeaways. They didn't move rates. So rates held steady. Fed funds rate held steady. You had an unusual level of dissent. In fact, of the 12 voters, 3 voted to hike rates. So while occasionally we've had 3 voters vote against the chair, against the decision, or at least against the statement, this was against the decision, and it was all in the same direction. And that hasn't happened in a very long time, that the voters were all saying, look, rates should be higher. We shouldn't be super surprised by this, though, honestly. If you looked at the dot plot, which is basically where Fed governors think rates are supposed to be or should be in their best estimate, where they think they should be, not where they think they will be necessarily, but where they think they should be, at the end of this year, we can see about half the Fed said they think rates should be 1 to 3 levels higher, so 25 basis points to 75 basis points higher than they currently are. So we knew we had a divided Fed going into this. And now we have a Fed chair, and I think we've seen this, who has decided that really he wants to change how the Fed communicates, how it does business. So we're going to talk about all that stuff. But first, let's talk about how the markets reacted. What did we see in the bond markets? I'm an economist. I don't trade bonds every day, but we've got someone here, Scott McGrath from our trading desk, who does it every day, talking about what they saw in the Treasury markets.
Yeah, Ian, and this was the first meeting in a very long time where the market was a little bit uncertain with what the Fed was going to do. There was some talk or some whispers, or would they actually hike rates without really telegraphing or giving the market a heads up? Probably the base case was that they would pause rates, but essentially what that means is more volatility in trading on the interest rate curve. So what we did see obviously was they announced the pause, at 2 p.m. Eastern, and then you saw markets kind of move up and down as they digested that statement, and as Chairman Warsh started his press conference at 2:30 Eastern. You saw a mix of reactions. So you saw rates move lower, then they rebounded to where they were higher prior to the announcement, and then ultimately moved back down as the chair was making his comments in the press conference. So I think with some of the limited visibility in what they are thinking over the longer run, of course, their next meeting's in September 16th. We're going to continue to see the market try to digest not only economic data, but also, try to figure out what the Fed path will be, and that will all lead to some additional volatility in rates trading accordingly.
So we've also got Thomas Montgomery, former Fed staffer here. One of the interesting things Chair Warsh has done is he said, I want to change a bunch of things about policy. I want to address different issues. I'm going to create these 5 task forces. I think like the Fantastic Five or somehow pops into my brain here. And we've got Thomas. Tell me about the task forces. What are key takeaways? What topics are they addressing? Do you think it's really going to make much of a difference?
Sure, Ian, thanks. So we didn't get too much additional color at this meeting on the task forces, but we did get more information about 2 or 3 weeks ago when the actual staffing of those task force and their specific mandates were announced. The 2 that really jump out to me that will matter over the next 6 months for us, is the Fed Communications Task Force and the Productivity and Jobs Task Force, which is really essentially the AI task force. Fed Communications Task Force, which is, of course, taking a lot of interest because of the new approach that Warsh has to communications, is staffed with some really great economists. All 3 of them are former central bankers, one from the US and one from Brazil, and of course, Mervyn King, very famous out of Bank of England. And while they're very well respected, all 3 of them have talked very publicly in the past about they're against forward guidance. So I don't think we should be surprised if in about 6 months from now they come out with a finding that the Fed should engage in less forward guidance. Whether the rest of the FOMC accepts that finding is up to them. They'll have to be convinced through pretty credible research and data. The other task force that I think has garnered a lot of attention is the Productivity and Jobs Task Force. Again, that's essentially the AI task force, which wants to focus on, well, is AI going to be a net inflationary or net deflationary force, essentially, over the coming years? The question or the answer to that right now is looking like, well, in the short term, more likely to be inflationary because just how much demand and how much lending is being required to build these out. But the staffing of that task force has garnered some questions. We saw that at the press conference, that there is one Stanford economist on the task force who also has worked at Anthropic, but the other two are people that are active in the AI industry, one from Andreessen Horowitz and the other from Microsoft. So there's a question of, are these task forces already predisposed to certain findings? And is that going to influence how well they're able to convince the other 18 members of the FOMC to adopt whatever findings that they propose?
Yeah, that's a good point, Thomas. It's definitely a wait and see on those, and how relevant are they, or does it feel like it's more of a rubber stamp for what Chair Warsh wanted to do anyway? And right now, clearly, he doesn't have full control of the Fed. He's, there's degrees. He's new. Typically, chairs, while they're only one of 12 votes, typically they're pretty influential. They seem to be able to herd the cats, so to speak. And they basically always vote with majority, but I don't think that necessarily means their opinions always with the majority, but that is kind of how the Fed historically has worked. Now, going forward, where do we think rates are going to go? I think this is a good time to get all of us. There's multiple opinions here, even at Huntington, but I think our base case going into this was, we said there's no move. We were pretty confident on that. Part of why was back in June, we didn't move. And the reality is, the Fed has two mandates, right? They look at inflation and they look at job market, unemployment rate, job growth. How's the health of the labor market? And what we've seen since June, we've had a couple data points on inflation that were big drops in inflation. We saw month on month, for example, the consumer price index was actually core CPI, which includes volatile food and energy, was flat month on month. We saw PPI actually fell, so that's what companies pay to prices companies pay to other companies for goods. And job growth dropped significantly off the pace we saw the prior 3 months. So it really was a case where I didn't see, and our team didn't see, a shift in the data that really supported changing the outlook. Now, what we've also seen, though, and this is why, at least one of the dissents was incredibly well telegraphed. It was Fed Governor Logan from Dallas. I mean, she in a speech really came out and said, she basically just said very explicitly, rates should be higher. There wasn't much couching, there wasn't any hedging. That's really unusual. Fed governors will sort of hint at what they want to do. It's very rare for them to be that explicit. So clearly, she had a couple people with her. And there may be more, such as Governor Cook, FOMC member Cook. She as well has sounded more hawkish lately. So there seems to be, now we know there's at least 4 votes, I think, likely for hiking rates amongst the 12. So what do we see going forward from here? Despite saying we think there's 4 of the 12 that could likely vote to hike, it really is data dependency in my mind. We're going to get 2 more months. And so there's one thing to think about the jobs picture, really from May to February, May 2025 to February 2026, we actually lost jobs in the economy. There was no net job growth that entire period. Since then, March, April, May were really strong job growth months. So we had very good job growth. We had about 500,000 jobs added then. And then, June data comes in, it's just 55,000 jobs. There's downward revisions to the prior months, it's actually negative 74 to the prior month. So on net, they actually think the economy was a little smaller than they realized. And there was fewer jobs. So I think it's which trend holds will really determine it, both on the inflation side and the job side. Look, if we continue to get strong job growth, the unemployment rate holds steady, and so then the Fed feels like, okay, we can impose a little pain on the economy and we're not going to really raise the unemployment rate because job growth is good enough. If we slow that a bit, things will be okay. Second piece, of course, is inflation. And there's a lot of unknowns there. There's the Iran conflict, there's tariffs, and there's just generally, this massive AI investment boom we're experiencing. All these things are creating some inflationary pressures. How much and how much pass-through there are to, say, non-oil sectors, that the Fed is going to watch carefully. And by September, we'll have a good sense of, was the June data a surprise and just an outlier? Sometimes there's noise. It's a bumpy road. There's ups, there's downs. I do think that's part of what Chair Warsh hinted at when he said, someone asked him, what do you think of the most recent CPI print, the one I'm referencing? And he said, not much. Well, how much did drive your decision? He said, not much. Because I look at data basically over the longer term, and I look at longer term trends. Well, 3 months should give us, hey, was that a blip? Or are we in a 6-month trend of strong job growth, a 6-month trend of where we can afford some pain, and a 6-month trend of really way above target inflation? Because, the reality is we're in a 5-year trend of the Fed missing targets on inflation. So that's kind of our scenario, I think. And so where does that leave us? Look, I think this is probably a blip. I'll say March to May was probably a bit stronger. I don't think the economy accelerated that much and on a continual basis. So if that's right, if I'm right on that, and I think about 2-to-1 odds, I'll give you, so maybe 66-33 there. I say no hike in September and no hike the rest of the year. So we stay flat, which is roughly what half the committee thinks is going to happen anyway. Now, if I'm wrong on that and we get a couple more strong months of data where, strong job growth, relatively high inflation, then, I think hike in September. And honestly, if you get continued a couple more months after that, then it's another hike in December. So then you get to 2 hikes this year. So that's sort of my 33 case. I think, honestly, it could go either way. It's obviously a close call, and I'll really be watching the data carefully. Scott, Thomas, love to hear your thoughts. Where do you see this? Do you agree? Where do you see rates going? What do you think?
Yeah, Ian, I think it's helpful to look at what markets are pricing in too. And granted, that's a pretty volatile number and changes consistently throughout each trading day, right? But heading into the meeting, the market was essentially pricing in near 100% chance that the Fed was going to hike at their September 16th meeting. After the meeting, right now, the odds currently are sitting a little bit below that, more like maybe a 60% chance that they hike at that time. So I still think you have this divided market on really what to price in and what will ultimately happen. But essentially, as you look out into the first quarter of next year, the market does have 50 basis points of hiking priced in to the yield curve. And I think it's useful to realize that from the end of February, 5-year fixed rates, for example, are up about 70 basis points or 0.7%. And that has helped the Fed a little bit with tightening monetary conditions without them having to act. But I think as you noted, we're going to have a couple more rounds of inflation data, a couple more rounds of employment data coming out. As that data comes through, I think that really can change quite drastically, the market's pricing, and those things happen relatively instantaneously, and you'll see that flow through into fixed rates, essentially based on how the market's viewing the next Fed meeting in September. And then also keep in mind we have the Jackson Hole speech too, which tends to be a point in time where the Fed can deliver some messaging that is inter-meeting that they want to convey to the public and the audience.
That did crack me up when he was asked about Jackson Hole, and he's like, "What do you have for that?" And he's like, "A blank sheet of paper." Was right. His response. That amused me.
That's right.
Yeah, I just pulled up on the market probabilities here, and yeah, it's looking like right now 57% chance of, or 0.57 hikes. They say by September, 1.25 hikes is the applied probability by December, and 1.5 by January meeting. So
yeah, and that could be right, and that could be more theoretical, right? I mean, in reality, what we have seen, right, if they were to have to hike, generally they hike in a series, like you mentioned, Ian, right? If they one quarter point hike probably doesn't do much to impact the economy or the trajectory of inflation, right? So if they were to start a hiking process, my guess is they would probably be telegraphing, hey, we have a little bit more to go. And I've even seen some comments of, hey, if they really get behind, maybe they'd have to hike by 0.5%. Anyway, that's all tail risk
No,
type of
that's a
stuff,
really
right?
good point.
But
It is tail risk. And,
yeah,
the last two cutting cycles we had were September to December, both times. It feels
yeah,
like we're setting up for this again. So the last 2 years, we've had September to December, 3 meetings, 3 cuts, both times.
yep.
So they did both times. They did 3 cuts and then waited. So do we get 3 hikes and then wait? I mean, I think that's a good point. But it is, yeah, and I think that's part of what we have to think if you're a client here and you're talking about this is the tail risk is high. The short end is still relatively attractive. It's still relatively low rates. And then the thing too with like say in corporate borrowing, if you're doing bond issuance, bond spreads are really cheap. So while Treasury base rates may be a little higher, the actual rate you're paying, because you're paying Treasury plus spread, is pretty low. Same thing actually in the bank loan market as well. You're paying SOFR plus a spread, and those spreads actually are at historically low levels. We're near some historical lows of all time. So this is but how do you, so you're a trader all the time. Scott comes to you. So, okay, I see this tail risk. What do I do?
Yeah, I think first is you gotta understand your exposures, right? What is your mix of floating rate exposure and fixed rate exposure, and how does that fit into your risk tolerance? And I think that's the main question and answer session that then determines where you go from there. Of course, a lot of our borrowers, their debt is initiated at a variable or floating rate. So essentially, they start off being 100% exposed to floating rates. There is a sense here, obviously, when you have a wider dispersion of potential outcomes, you have a lot more risk involved with what actually will happen. So generally, when you're kind of trying to fit a strategy to fit into that risk tolerance level that you would have as a company, you don't want to be caught off sides. You don't want to have too much risk. You don't want to have too much exposure to a varied or an uncertain set of outcomes. So what we would do is we would look at structuring, a fixed versus floating type of strategy that really gets you into the sweet spot that you're comfortable with and that you can really have some protection against both tails. And I think that's the most important evident here in this environment, given the uncertainty that I think we're entering into.
And I think
Yeah.
one of the points, though, is interesting. Sorry, the tails. I'll let you jump in a second. Is the tails are really asymmetrical right now.
Mm-hmm.
If we go through the end of the year, no one has a case for cuts. I think it would be very hard to build a scenario for cuts. So what I mean then by asymmetrical is there isn't a case for cuts. It's all upside. It's sort of the risk. The basic risk is the lowest rate case right now is flat, and the upside risk can be significant. I mean, I think you're right that we could see 3 hikes if the data really come in the wrong way. If a coalition forms at the Fed that you're seeing the startings of it potentially, that sees this as something where we need to act and we need to act aggressively. I think 75 is not a crazy thing to say. We could get 3 hikes this year. It's definitely out there at the tail, and that's why I'd call it a tail risk. I think it's a bit strong and probably unlikely to happen. That strong a move, but it isn't something you could rule out. I think we could I'd say 3 hikes is far more likely than 1 cut. Mm-hmm. If I had to lay out the scenarios for the rest of the year. So Thomas, you were about to jump in and add to that.
Yeah, I was going to say that the strategy Scott put forth with regards to swaps makes a lot of sense, because one of the things we did get plenty of clarity out of yesterday was that Chair Warsh is pretty comfortable with volatility. But it's important to remember that a lot of the yardsticks that he really cares about, medium to long-term inflation expectations, have been pretty flat. The 5-year forward break-even is about where it was at the start of this year prior to the conflict. The 10-year inflation break-even is down since Warsh took charge. So the path of rates, I would agree with your assessment, Ian, that we're definitely looking towards more likely, in my opinion, of rates being unchanged. But in terms of a tail risk, we got that geopolitical wild card, or what poker players call a kicker. So if you want to not have uncertainty, going with a swaps-based strategy makes a lot of sense.
Yeah, it's an interesting dynamic we have going from here. So yeah, with that, I think those are your key takeaways from this meeting. You know, rates didn't move, but we certainly see upside risk out there right now. And it really is something where we're going to be watching the data carefully over the next couple of months. We'll let you know how that evolves between now and the next meeting where we see this. But I think what we do know is there's 3 and probably 4 who've signaled, the voting members of the FOMC, who signaled they want to hike rates. And 12 is a majority. So those fence sitters in the middle, really, whereas the data is there, they will move on the data. I think it may not be the chair. This may be against the chair's wishes. It may not. This is reality of the Fed. Is you have 12 strong personalities, very accomplished individuals, and they're going to each see this a little differently. And so what you have to think about is there's a couple of our base scenarios. Our base scenario, we'll say 66 probability, is probably no moves this year. Mm-hmm. But that really requires somewhat weaker job growth combined with somewhat relatively low inflation, or at least inflation trending downward, the rate of inflation slowing. If that doesn't happen, then 1 to 2 hikes. And, as Scott pointed out, when the Fed starts hiking, they realize moving a loan interest rate 25 basis points doesn't do a lot. Moving at 75 really does. And so they may begin a series of hikes. So that really, the upside risk could potentially get as high as 75 by the end of the year. I think that's a pretty unlikely scenario, but 1 to 2 is pretty reasonable as well. So you really have to trade with that in mind and think about managing your exposures with that in mind as a company and how you manage this. So with that, I really appreciate you guys joining me today. Please like, subscribe, follow. It's got Ian Wyatt, Scott McGrath, Thomas Montgomery from Huntington Bank.